Ind AS 8 Accounting Policies Changes in Accounting Estimates and Errors. Accounting Policies. What is meant by accounting policies? Accounting policies are specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. Examples of accounting policy. Basis of accounting, either cash basis or accrual basis or a hybrid mode, is an accounting policy. Basis of measurement of non-current asset, either cost model or revaluation model. Next, method of determination of cost of inventories, FIFO or specific identification or weighted average method. It is the type of accounting policy. Selection and application of accounting policy. How an accounting policy is selected and applied. When specific Ind AS is available, follow that Ind AS and apply the policy as per guidance provided in that Ind AS. When specific Ind AS is not available, management shall use its judgment in developing and applying an accounting policy. Policy developed using judgment shall result in information that is relevant to the decision making of the users and reliable. In making judgment, management shall refer and consider the applicability of following sources in descending order. First one, any other Ind AS which are dealing with similar and related issues. Second, basic framework of Ind AS which provides the general principles. Third, pronouncements of International Accounting Standards Board IASB. Fourth, pronouncements of other standard setting bodies having a similar conceptual framework. Fifth, check the accounting literature and accepted industry practices. Accepted industry practices. Next, consistency of accounting policies. An entity shall select and apply its accounting policy consistently for similar transactions, but if an Ind AS specifically requires or permit categorization of items, then an appropriate accounting policy shall be selected and applied consistently to each category. Example number one, an entity has grouped its PPE into four classes, namely land, factory building, plant and machinery, and furniture. The entity may propose to apply a revaluation model only to land and cost model to others. It can do so. Only revaluation model to land and cost model to others permitted. Example number two, Ind AS 2 inventories requires that inventory to be valued at cost or NRV, whichever is lower. In identifying cost, it allows alternative cost formulas, FIFO and weighted average. The same cost formula must be applied to items of inventories having similar nature or use, but a different cost formula can be applied to different classification of inventories. Next, changes in accounting policies. An entity shall change an accounting policy only if it is required by an Ind AS or results in financial statements providing more relevant and reliable information. So, an accounting policy can be changed if it is required by any Ind AS or changing in such accounting policy results in more relevant and reliable information. Following are not changes in accounting policies. First one, application of an accounting policy for transactions that differ in substance from those previously occurring, and application of a new accounting policy for transactions that did not occur previously or were immaterial. These two are not considered as changes in accounting policies. Example, an entity had previously classified a PP as owner occupied property, where it was measured at initial recognition applying the revaluation model. The same is now being classified as investment property. Ind AS 40 on investment property permits only cost model. Here, as per Ind AS 40, revaluation model is not applicable, not permitted. The entity now measures this investment property using the cost model. This is not a change in accounting policy. Next, applying changes in accounting policies. Another first one, change in accounting policy resulting from application of an Ind AS, and that Ind AS itself provides specific transitional provisions. Follow the transitional provision. Second, change in accounting policy resulting from application of an Ind AS, and that Ind AS does not include specific transitional provisions. Apply the change retrospectively. change in accounting policy is made voluntarily, apply the change retrospectively. Earlier application of an Ind AS is not a voluntary change in accounting policy. When in absence of an Ind AS that specifically applies to a transaction, an accounting policy was applied from the relevant IFRS or most recent pronouncements of International Accounting Standards Board (IASB) or other standard bodies, and following an amendment in such IFRS or pronouncement, the entity chooses to change its accounting policy, then it will be considered as if the company is making the change voluntarily, and accordingly, it should apply the change retrospectively. Retrospective application, Ind AS 1 makes it compulsory for the entity to present a third balance sheet as at the beginning of the previous year if it applies an accounting policy retrospectively. Retrospective application is defined as applying the changed accounting policy to the transactions as if that policy had always been applied. That means retrospective application of change means we need to change from day one onwards. Next, this means that comparative information for all preceding periods presented will be adjusted for effect of the change in policy. The amount of the resulting adjustment relating to periods before those presented in the financial statements is made to the opening balance of each affected component of equity of the earliest period presented. The restatement of financial statements for prior years does not mean that actual approved and issued financial statements have been withdrawn and amended. The extract of balance sheet particulars opening as on 1st April 2017 reserves to be adjusted with the difference relating to 2016-17 and before year, previous year, 31 March 2018, current year, 31 March 2019. What is the limitation of a retrospective application? When retrospective application is required, but it is impracticable to determine the effect of the change in previous years, that is prior years, that is not possible to determine either period specific effect or cumulative effect. In that case, the entity should apply the accounting policy as at the beginning of the earliest period for which retrospective application is practicable. Impracticable. Applying a requirement is impracticable when the entity cannot apply it after making every reasonable effort to do so. For a particular prior period, it is impracticable to apply a change retrospectively if retrospective effects are not determinable. Retrospective application requires assumptions or estimates of amounts which are supposed to be taken in that respective year, considering the evidences and information on that date. Disclosures. Nature of change in accounting policy need to be disclosed. Reason for change in accounting policy need to be disclosed. Effect on current year and prior periods due to change in accounting policy need to be disclosed. If retrospective application is impracticable, disclose the reason for the same. When an entity has not applied a new Ind AS that has been issued but is not yet effective, the entity shall disclose this fact, and known or reasonable estimable information relevant to assessing the possible impact that application of new Ind AS will have on the entity's financial statements in the period of initial application need to be disclosed. Next, accounting estimate. What do you mean by accounting estimate? Estimation involves judgment based on latest available and reliable information. Accounting estimate means estimation made by the management based on their judgment pertaining to accounting. Examples where estimates are required regarding bad debts, inventory obsolescence, fair value of financial assets or financial liabilities, useful life, residual value, method of depreciation, warranty obligations. Reason for change in accounting estimates because of new information, more experience, new development. Accounting for change in accounting estimates. Apply the change prospectively. Prospective recognition means the change is applied to the transaction from the date of change in estimate. The change in accounting estimate may affect only the current period's P&L or the P&L of both the current period and the future periods. Other important points. Can the change in estimate be related to prior periods? The answer is no. It does not relate to prior periods, and is not the correction of an error. Change in the base of measurement, whether it is a change in accounting policy or change in accounting estimate, it is a change in accounting policy. When it is difficult to distinguish between a change in accounting policy and the change in accounting estimate, treat it as change in accounting estimate and give prospective effect. Disclosures in case of accounting estimate. Nature of change in accounting estimate, amount of change in accounting estimate, effect due to change on current and future periods, if not possible to estimate the effect on future periods. The fact that fact must be disclosed. So nature, amount, effect. If effect is not possible, fact must be disclosed pertaining to accounting estimates. Next, errors. What do you mean by error? Errors are omissions and misstatements in entities' financial statements for one or more prior periods, arising from failure to use or misuse of reliable information that was available when financial statements for those periods were approved and could reasonably be expected to have been obtained. What are the types of errors? First one, mathematical error. Mathematical error means a wrong calculation, carry forward of wrong balances, errors in totals. Second, mistakes in applying policies. Example, assets and liabilities should not be offset unless permitted by Ind AS. If not permitted and offsetted, then it will be an error. Third, misrepresentation of facts. Example, misinterpretation of facts. Misinterpretation of facts. Example, misinterpreting definition of adjusting and non-adjusting event as per Ind AS 10. Omissions. Omission to record material transaction due to oversight. Frauds. That means example, major theft undetected in the past. The following errors occurred in preparation of A Limited financial statements for the immediately preceding financial year. Depreciation on plant and machinery understated by 0.30% of the sales. Warranty provisions understated by 0.15% of the sales. Allowance for bad debts understated by 0.25% of the sales. Individually, none of these errors may be material, but could collectively influence the economic decisions of the users of the financial statements. These are material prior period errors. Accounting treatment of errors. If error discovered relates to the comparative prior period presented, unless impracticable, correct material prior period errors retrospectively should be adjusted by restating the comparative amounts for the prior period presented in which the error occurred. If error discovered relates to period before the earliest comparative prior period presented, unless impracticable, correct the same retrospectively by restating the opening balance of the assets, liabilities, and equities for the earliest prior period presented. Next, as per Ind AS 1, whenever there is a requirement of retrospective effect, an entity should prepare previous year opening balance sheet as well. That is opening balance sheet as on first day of the previous year. If retrospective restatement is impracticable, same treatment as we saw above for the change in accounting policy need to be done. Use the words restated in the balance sheet and P&L after correction of prior period items. What are the disclosures pertaining to errors? Nature of error, amount of error, and its effect. If retrospective restatement is impracticable for a particular prior period, the circumstances that led to the existence of that condition and a description of how and from when the error has been corrected should be disclosed. So the nature, amount, and if the restatement is impracticable, the fact should be disclosed. Why it is impracticable should be disclosed.